Hey guys, David Robinson here. Welcome to the apartment investing journey. Got a great guest for you today. I'm excited to get into his story and have him share sort of the journey that he's been on to go from his corporate career to full-time real estate investing and the exciting things he has moving forward in his world of real estate investing. So, Raj, welcome to the show. I appreciate you coming on.
Thank you for having me here, Dave.
Yeah, my pleasure. So a little bit about Raj. He is a real estate investor and syndication general partner, an engineer by training, and has an MBA from the University of Maryland. He spent over 20 years working with Fortune 500 companies, FedEx, Walgreens, CVS, Johnson & Johnson. He is married for 20 years, has two children. And he's exited his corporate career and has transitioned into full-time multifamily investing. And he started investing in 2017 and now has 29 units across 4 multifamily properties in 2 separate states. And he is part of the real estate syndication group. And Raj, that's a very brief bio. And I want to get the whole journey and talk about the process that you've been on as you've made this transition. And so if we can, let's back up and let's talk about what life looked like for you when you were first exposed to real estate investing and how you made this transition out of your corporate career into full-time real estate investing.
Yeah, thank you for the introduction. And I'd just like to make a quick update that I should update my bio. Most recently, we have just done a deal in Colorado. We have taken over a hotel and we are converting into multifamily properties. So very excited about that. It's recent, so it's not in my bio.
Well, maybe we'll have a chance to chat about that as well.
Yeah, certainly. So I got exposed to multifamily real estate investing not so long ago. So January of 2017 to be precise. And I recall that until that time, I was a full-on stock market investor. And I had been doing it for 10 years and I did reasonably well. I'm sure there are people who have done better than me, but I can promise you there are people who have done much worse than me also. So I came across a blog and it talked about multifamily investing. What I liked about that blog is it talked about the math behind multifamily investing. So I'm a numbers guy. Numbers speak to me. Spreadsheets is my playground. So I was like, oh my God, look at this. So this is cap rate. This is cash on cash rate. This is better than stock market. Wait. Is it? Yes, it is. And then I did some sensitivity analysis. I'm like, okay, what if rent collection was a little less and, my loan terms were a little poor and it continued to show better returns than stock market. So I did a double take. And then I was like, is it true? Is it for real? And then I kind of sort of dipped my toes in the water. So I bought a triplex, not so far from where I live. And so I bought it in Harrisburg, Pennsylvania area. Okay. And I started running it and it's legit. It's true. It's a good investment vehicle. Next year, I doubled down on it. So I bought 6 units, 2 properties, closed them on the same day, and had some interesting experiences along the way. My property manager sued me. One of my tenants sued me. It's a matter of when, not if. It's going to happen, guys. But having said all that, that investment also proved to be lucrative, very good. And I'm very happy that I still did it. And then the year after, 2019, before 2019 became known for COVID, I bought another one in Ohio, which was a leap of faith, no pun intended, because I live in Pennsylvania. So I bought a 20 unit there. So all of this is my personal investment.
Yeah.
And I kind of got into a bidding war on this property, got it purchased it, still running it with the property manager over there, and very happy that I did it. And I went into syndication. I'm a general partner. I'm talking to a lot of limited partners. We're looking at a lot of deals. And most recently, I did this deal in Colorado where we took over a struggling hotel in the neighborhood because of COVID. It's a good time to buy hotels if you can find a good deal in a good market. And we just closed on it a month ago. And that's my real estate journey. I'll strongly recommend it. And maybe later down the line, I would also like to talk about one other thing that I'm doing. It's on the small business acquisition side. So just like you can buy real estate, any kind of real estate, I focus on the multifamily asset class. For cash flow. You can also buy a small business for cash flow. So a flower shop, a laundromat, a gym, whatever you have, you can purchase them, and they run a little differently. You need to have slightly different type of skills, but I'm kind of diversifying between these two type of asset classes for my investment portfolio. So long answer short, started in 2017, continued going, very happy, strongly recommended.
Love it. Well, let's unpack a little bit of that. So you started in 2017, stock market investor. You started to, you come across a blog that talks about multifamily and you start researching it. You're a numbers guy. So you're breaking out your spreadsheets and running calculations and looking at a side-by-side scenario of the stock market versus multifamily investment. And you end up diving into the triplex and the triplex and then, 6 units with the 2 other properties. And you have some interesting experiences. So most people, if they got into that world and had the experiences that you had of being sued by the property management company and by the tenants, they might say, hey, you know what? I'm out. I would rather just throw my money in the stock market, not have to think about it, not have to do anything with it. What caused you to continue to push forward?
Yeah, that's a good question. I think when you grow, like we are talking about growth from a real estate multifamily investment lens. And you could grow in any life dimension. So it's health, wealth, spirituality, deep relationship with your friends and family, whatever excites you, right? So we're talking about it from a financial mindset is very important. So you should have a why. Why are you doing this? And at that point, it was my financial freedom. That was really, really important. So now that I have attained that, my goals have become different. But I had a strong why. And I had been warned by people that, what's that? Termites, tenants, toilets. And I'm like, oh my God, what if somebody called me in the middle of the night and complained about a stuck toilet? I can drive 2 hours. And, But, I'm like, okay, it happens. You have a property manager on site. You don't give them their number. You call property. Okay, problem, solution. So I kind of knew that this happens. And so when this happened, it's not fun. I'm telling you, it's not fun. And you would question your choices. And you're like, what did I do? I was nice and honest and fair in my business dealings. Why me? Why this? But at the end of the day, most successful people will tell you that it's the cost of doing business. And so what if you get sued? So what if you have to pay some money in out-of-court settlement or in-court settlement? So what if you have to pay some legal fees? All said and done, like consider this as operating expense. And as practitioners of real estate know that all OPEX, operating expenses, go up and down, and long-term average is what you underwrite your deals with. And just deal with it. And if you learn from your mistake and you pick your real estate business partners more carefully next time, then it's with hindsight, it's a good experience, and I don't hope that it happens to any one of you, your listeners, but it does happen. Things do break down. Relationships do break down. People do get sued. Deal with it, learn from it, choose better partners, move on. And at the end of the day, I deal with a lot of cliches, but I'll say this, like anything that's easy to do is probably not worth doing. So I bet your listeners, your viewers know this, that it takes a little bit of work. It takes a little bit of focus, and it takes a little bit of skill. But once you get past all this, it's totally worth it. Does that answer your question?
Yeah,
did I get
absolutely? No, that's great. I think the key point here is that you're going to face adversity regardless of the path that you take, and having that why that's driving you forward. And yours was financial freedom. You wanted to achieve financial freedom. You saw this as a path, and so you're willing to, overcome the obstacles that would keep you from achieving your goal. I'm curious. I want to unpack a couple pieces of your journey, and that is you started out with residential multifamily. So generally, we define residential multifamily as 2 to 4 units. Anything above 4 units, we would define as commercial multifamily. So you started out in buying a triplex and then 6 additional units with 2 properties. And then you moved to a 20 unit in a different location. Now, I don't have a map in front of me. So how far away is Ohio from Pennsylvania, from, let's say, just a driving distance?
It's an 8 hours drive in Tesla.
Okay, great. So you made 2 big shifts. Number one is you moved up into the commercial realm. And then you also invested outside of your local market. I know that we have a lot of listeners who have invested in small multifamily property and are now looking to scale up into commercial. And so I think you might have some insight to share as to why you did that and what that experience was like for you moving into the commercial realm and also investing out of your local market.
That's an excellent meat and potatoes question. First of all, I'd like to give shout out to my mentor, Matt Faircloth. And if you haven't talked to him, I strongly recommend you have him over your show. First class guy. And he mentored me, and he still mentors me. And one of the things that I learned from him is that he said, Raj, look, you want to scale. In this business, you want to scale. And one way to scale without ever being in over your head is to double the size of your portfolio with every purchase. Okay. So you have 3, your next should be probably another 3. So now you go from 3 to 6. Your next should be 6. So now you are 12. Next should be 12. Life always doesn't work such black and white manner, but this is a good format for you to follow. So at that point, I had 9. I should have bought another 10 unit. Okay. But I found a good deal in Ohio market. So I was like, I got really excited. The cap rate projections, the cash and cash projections were solid. And the market was heating up at that point. It was not as bad as today, but it was starting to heat up. The second thing that I would say is that Brandon Turner, another shout out, wonderful guy. He talks about, processes and systems. And even if you buy right under your nose, which many of us do for our first deal, it's fine. But you should not sign up, at least it's my style, to buy a wrench and start turning wrench every time there's a problem. If you do, more power to you. It's just, I don't know it. I'm a financial guy, and I would like to scale my time as well as investments. So if you're buying a property right under your nose, and if you plan to get it operated, run by a property manager anyway, is it really such a huge leap of faith if you purchase the property right under your nose or 8 hours away from you? So, in fact, just today, I got a love letter from the city where one of my properties is, and they just sent me a letter, and they said that you need to take care of this weed or grass or whatever. And if you don't do it by tomorrow, then there's a fine and a risk of imprisonment. imprisonment.
Wow, that's serious.
That's it. And my property manager says nobody goes to prison for this, but they do mention it in the letter. Bizarre. But it's hour and a half from my property. I'm not going there. I scanned that letter, emailed it to my property manager, and he's going to take care of it. So if the same thing happened to me in my Ohio property, I'll do the same thing. So we live in an electronic world. And if COVID-19 taught us anything, it taught us that you could connect and take care of business from far, far away. So my philosophy, and it's working for me, is that I need my business to cash flow and make money and appreciate. And that's my number one criteria. It doesn't really need to be under my nose. In fact, it's probably better that it's not so close to me so that I can look at that asset dispassionately, objectively.
Yeah. Yeah, I can see there is value to investing outside of your local market, specifically because it forces you to look at it strictly as an investor who is going to hire third-party professionals to help you manage that deal. And it also forces you to look at the financials in probably a little bit different than you would if it was under your nose and you had the flexibility to, self-manage or go and view the property on a daily basis. So I can imagine that there's some benefit to you, and that's great that you made that transition and that you bought that property. I'm curious to discuss this transition from your corporate career to real estate investing full-time. And at what point did that happen in your real estate investing journey? And what guidance might you have for our listeners that are looking to do the same?
This is a very good question and something that's close to my heart. So, as I said earlier, my number one goal was to pursue financial freedom, financial independence, meaning that paid work becomes optional. You do your paid 9-to-5 W-2 job because you want to, not because you have to. And I've been on that path through stock market investing for about 7-8 years. And I was doing okay. I was doing well. But then I stumbled upon real estate investment. So there are some people who are very good at stock market. There are some people who are very adept at real estate investing. There are not a lot of people who do both. So I can offer up this perspective to your listeners. So, and it could also apply to your retirement life, retirement income. So there is a phrase that goes around. It's called safe withdrawal rate. It's bandied about in personal finance world a lot. SWR, safe withdrawal rate. And essentially what it is what percentage of your net assets could you withdraw year after year without you running the risk of going broke in your retirement, right? That number is 4%. Okay, so people did a lot of analysis, looked at all stock market returns since the beginning of time, and looked at different 30-year windows. And they did Monte Carlo simulations. If you don't know what that is, don't worry. I'm just trying to look smart to you. But after all that analytical work, they came to the conclusion that in the worst of times, even if you retired at the beginning of the Great Depression, or 2008 crash, you could still withdraw 4% year after year, give yourself an inflation equal raise, and never run out of the money in your retirement. So that's 4%, okay? So if you have $1 million in your stock portfolio, first of all, congratulations. And second of all, you can withdraw no more than $40,000 a year every year for your retirement age. And if you compare and contrast this with the real estate, multifamily real estate world, I'm sure you know about cap rate, cash rate. So cash and cash rate, at the risk of stating the obvious, if you invest $100,000 plus the debt, how much money you can withdraw on a yearly basis, that's cash and cash. So I would say that if you find a property which gives you 12% cash on cash, you're not a genius. It's normal. It's typical. Would you say that, David? 12% cash on cash?
12% cash on cash is that's a great cash on cash return.
In syndication world or in personal world?
Both, in my opinion. So
okay.
B class, cash on cash return. Now, if you're looking at the average annual return or an IRR, getting up into the 15%, high teens is great. Cash on cash, I'm generally seeing somewhere in my market in Utah for small multifamily property. We're looking at cap rates. We're looking at cap rates of 3.5 to 4.5. So having a 12% cash on cash return is a great cash on cash return.
So, okay, that's fair because mind you, I bought my properties before the market heated up. And if 12% cash on cash, I do C-class, mostly C-class, Dave.
Gotcha.
So that also helps. But it's not difficult to get 15 IRR, 13 IRR, 14 IRR when you sign up with somebody else's syndication as an LP.
Sure.
Right?
Sure.
So let's just say 12%. Okay. So 12% IRR in the world of multifamily syndication as an LP. So if you have $1 million invested in somebody else's syndication, and you don't even have to run the syndication, you don't even have to be the GP, you're just an LP. Okay. You will get $120,000. And I compare and contrast this with what I said 2 minutes ago, 4% SWR. So if you so it's $40,000 versus $120,000. That's one. That's two, you get the benefit of leverage. Number three, it's very tax efficient. Number four, I don't know about you guys, but I like my asset classes to be physical. I can go and touch and fondle and smell the underlying asset versus on stock market, it's zeros and ones floating around in the ether.
Right.
So there are a lot of reasons why real estate investment is so much better from my standpoint. I don't want to beat down, and I don't want to say that stock market investment is not good for you. I'm not going to say that, but for me, my personal experience, real estate investing is so much better. So that's the context. So I started my journey in the pursuit of financial independence. I gained momentum using the stock market investing. I did okay, but then it turbocharged with the multifamily real estate investing. And in a couple of years, my journey was complete. My passive investment exceeded my lifestyle expenses, which is the classical definition of financial independence. And I fired. And actually I fired, and I kind of sat on the fence for a while, like, should I do it? Should I not do it? Should I do it? And then I did it. And here I am. I think I've been very blessed and very fortunate to stumble upon a good asset class, run into good colleagues and good mentors, find good business partners. And that's what helped me along the way.
Well, that's great. And just to give us some context, you started investing in roughly early 2017 in multifamily. Obviously, a 10-year stint of stock market investing. When did you fire yourself, or when did you leave your corporate career?
It's an interesting acronym, isn't it?
Yeah.
Yeah. So I hung my corporate boots April last year.
Great. Good for you. Yeah. Congratulations.
Thank you. Thank you very much. Thank you very much. People didn't even know, because people thought that I'm just working from home because of COVID, just like everybody else was.
Yeah. So, yeah. Do you miss being involved in the corporate world?
Nah, man.
Yeah.
Nah. I did okay. So I worked for some really good companies. I rose to the ranks of director. I managed teams. I worked for some cool people. But all said and done, at the end of the day, I'm enjoying this part of my career more than I enjoyed the corporate careers. the freedom to schedule your own time, being your own boss, getting tons and tons of unanticipated tax benefits. And one thing that was surprising to me, Dave, was that there's a whole world out there. People like me who work for themselves, entrepreneurs, financially independent people that I was not privy to. I was oblivious to this world because you're just doing this 8 to 5, 8 to 5, 8 to 5. You start your week on Monday, you end up on Friday, you go to the bar, you get a couple of drinks, and you spend your Saturday, Sunday, and then rinse and repeat. So you never get a chance to look at this other world. But now that over the past 1 year, I have learned about other opportunities, other people, some of the other things that you could do, and give yourself the freedom to hit the gym at noon, that's outstanding. That's outstanding.
Well, and it lends to, this concept of financial independence. I mean, the definition, that people have for financial independence varies from person to person. But ultimately, being able to choose when you work and how you work and where you work could be a definition of that financial independence. And, achieving that's a great success. We're needing to start to wind down here, but before we close things out, I want to chat about your most recent acquisition, this hotel conversion. We don't have time to dive into all the details, but I would love to hear an overview of A, how you found that opportunity, and B, how you financed and where things stand with that opportunity.
Yeah, I'm very excited about that deal. And truth be told, my awesome business partners found this deal and they brought it to me on a platter and said, Raj, just sign on the dotted line. Essentially, no. But, we talked and we had a lot of discussions, and we are about 6 business partners in this deal. And there's a husband and wife team in there. And she grew up with parents who were very handy and they were in construction. So she has it in her DNA. So she looks at an asset like that and her mental gears start to crank in a different way than mine do. So it's a team of eclectic people, different skill sets. And she said that there's this deal. And she found my business partners on her Slack channel. And they started talking to her. They saw her vision. They believed her. She is skilled, smart, sharp. She has a vision. And then they brought me along. We had conversations. So I participated in the deal myself. And as we speak, that team is there in Colorado and starting to turn those hotel rooms into multifamily apartments. Interesting market, blue collar, predominantly blue collar opportunity. After the conversion portion of the project is over, it will become a more traditional multifamily asset and it'll start throwing off cash flow.
So how many units is it total?
It's 32 units.
32. And was it, what type of hotel was it before you guys acquired it? Was it your typical hotel, or did it have built-in kitchens, like a kitchenette? My understanding is that the hotel conversions are the most challenging aspect of it is replumbing to bring in full kitchens into each unit. I'm just curious about what that experience was like, if you had involvement in that side of it.
I had limited involvement on that side of it, but we didn't have to go full on kitchenette conversion aspect of the things. Plumbing, heating, wiring, all of that. These are good, reasonable considerations when you are taking on a conversion project. For us, the interesting thing in that market was the type of tenants who will be occupying these units is slightly different. They will live there for typically a shorter duration of time. Picture a minor, right? So he or she is going to take on the unit and probably not be doing a whole lot of cooking in there. And we will provide outlets so they could do some electric appliances, and they could do some cooking, basic cooking in there. And based on our own market research, that would satisfy the need of the kind of tenant pool that we are looking to attract. But your point is absolutely correct. That is a consideration. I feel like we will be doing another deal with this group of folks. And once this project gets under control, we will be going after other set of hotels. And that would be a more typical acquisition and conversion project. And in those instances, yes, we will be dealing with kitchen conversions and plumbing, etc.
Interesting. And so what was your main role in that project? Go ahead.
Yeah, so it's a joint venture. So my role was in working with other business partners in scoping the deal, underwriting the deal, understanding the market, funding the deal. And once the closing happened, some of us kind of are taking a step back and letting the core operational team take on the full-on responsibility of conversion and running and operating it. We are definitely here. If that team, husband, wife, I don't want to take the names.
That's all right.
If they need our help and brainstorming, then we are definitely here. But most of the work is in their court at this point.
Gotcha. Okay, great. Well, I want to wind down here, but I'm curious about what you see on the horizon for you and your business. Where do you see things going for you moving forward? And what are you focused on?
Yeah, so I'm focused on three things. Two things under syndication world, one thing under small business acquisition world. So on the syndication side, I continue to talk to potential investors. So there is a lot more money that is ready to be deployed in good deals than there are good deals, at least from my vantage point. So I also continue to look for syndication deals in growth markets across the country. I have a wide radius, A, because of my mindset, I'm okay, and B, I have two other business partners who live in Minneapolis and Boston, so it expands our radius. And the third thing that I am doing is I am looking to buy small businesses. So I'm under contract to purchase a small business in downtown Philadelphia. So doing due diligence right now. Pray for me. If this works out, we'll be closing. Thank you. We'll be closing September end. So I will be doing these two things in parallel.
And I'm just curious, for the lack of time, we won't go into a lot of detail, but I'm curious what kind of business it is.
Since I have signed an NDA, I'll keep it high level general. It's personal fitness industry.
Oh, interesting. Okay, great.
Talk to me after September. I'll tell you everything.
Yeah, maybe we'll have you come back on and talk about it.
Yeah.
So, Raj, we got to start winding down here, but I've got three final questions for you. The first question I have for you is, what has been your biggest win on your apartment investing journey so far?
It may sound like cliche, but I would say my first deal, even though it was the smallest, was my biggest deal because A, it made me comfortable, B, it gave me the lessons, and the second and third deal are much easier, even though they are bigger.
Yeah, love it. What's the biggest mistake you've made so far that we could all learn from?
I think the biggest mistake that I have made was associating with a difficult individual, and they wanted to run the property in a way that was not consistent with my values. And I, at the risk of being sued, I cut my ties with them. And since that was a breach of contract, I signed a 12-month deal with them. I was sued. They won. I paid them the money, and I learned my lesson, and I'm a better investor for that experience.
Yeah, absolutely. The importance of choosing partners that are aligned with you from a values perspective.
Values are more important than skills.
Yeah, great. Last question I've got for you. What's the best advice that you have for someone who's just starting their apartment investing journey?
I would say that it may also sound like cliche, but apartment investing is a skill that you can learn. And their process, the steps that you follow, and you follow it along, you'll have some setbacks, you will learn, and you will be an investor. The most important thing that I can offer from my vantage point is have a vision, have a why. Why are you doing it? And if your vision does not make you uncomfortable, then it's not big enough. If you tell your vision to somebody else and they don't laugh at you, it's not bold enough. And it should be really big. It should be so exciting that gets you out of the bed every Monday morning when it's raining outside. If it is too small, you will probably achieve it, but it's not going to excite you, and it's not going to change your life. So if you want to change your life, and if you want to do it through apartment investing, start with the vision, have a really ridiculous, bold vision, and commit to it.
Love it. Well, Raj, thank you so much for spending some time with us today and sharing your journey from being in the corporate world and spending a decade investing in stock market to being exposed to real estate investing, and in particular multifamily investing, and starting off with the triplex and then acquiring 6 additional units. And then your out of state Ohio 20 unit acquisition, and now taking a big leap into a hotel conversion, and on the horizon for you more syndication, multifamily syndication opportunities. Thanks for sharing your journey with us, giving us some of your insights that you've learned over the last 4 or 5 years. And what's the best way for our listeners to connect with you and learn more about your business and potentially partner or invest with you on future opportunities?
Yes. So first of all, thank you so much for having me. I wish you the best of luck to you and your listeners. And I enjoyed having a conversation with you. You are a very good listener. That's a strength. And the best way to reach out to me is my email address, raj@bigleague-capital.com. Big league as in baseball. You can also call me direct, 901-634-1478.
Okay, perfect. We'll have that information in the show notes. So if you've enjoyed the conversation we've had with Raj today and his story has resonated with you, if you'd like to reach out to him, click on one of those links down below or give him a call at the number he just provided. Raj, thank you so much for coming on, sharing your journey with us, and I look forward to connecting with you again soon.
Thank you, David. Best of luck.